The third step in preparing the consolidation worksheet entries in this question is to look at the pre-acquisition equity. So that's the third step. Just to refresh our memory, the first step is the acquisition analysis, and the second step is to deal with all the valuation adjustments against the BCVR. And we're now busy with the third step, the pre-acquisition elimination entries. The purpose of these entries is to eliminate the equity of the subsidiary at acquisition date against the investment in the subsidiary recorded in the parent company's accounting records for the following reason. This investment in subsidiary records the parent share of the subsidiary's net assets. When we add the results of the parent company and the subsidiary in order to get to the combined results of the group, we add the subsidiary's assets and liabilities. So effectively, we add those net assets again. Similarly, by including the equity of the subsidiary, from a group perspective, we're double accounting for the equity of the group because the parent owns that equity of the subsidiary. So by eliminating the subsidiary's equity against the investment in subsidiary, we are preventing that double accounting of the subsidiary's net assets and preventing to overstate the group's equity. Now on the acquisition date, this elimination of the pre-acquisition equity is as simple as eliminating the subsidiary's equity on acquisition date against the investment of the parent company. But as time progresses, adjustments need to be made to the at acquisition equity with regards to subsequent transactions or transfers that relates to pre-acquisition earnings. So you have to read the question very carefully for any indication that an adjustment or transfer is made from the retained earnings in existence on the acquisition date or pre-acquisition equity, because that's going to affect our entry. Now this is the basic elimination entry on acquisition date, and I refer to this as our basis entry for eliminating the pre-acquisition equity. So on the acquisition date, we eliminate the subsidiary's equity, which consists of retained earnings, share capital, and general reserve. So these three account balances, as well as the BCVR that is recorded on at acquisition date. So resulting from the fair value adjustments that we had to make on acquisition date, and which is viewed as part of the subsidiary's equity, even though it's raised on group level. And that we eliminate against the investment in subsidiary. In this case, that investment in subsidiary was calculated as the value of the investment at year end less the call that was made during the 6 months. So since acquisition date, which gave us then the consideration transferred on the acquisition date. So that is the investment in subsidiary adjustment. So the equity that we eliminate regarding to the subsidiaries equity is the equity at the beginning of the current financial year. So in this case it will now be on the acquisition date, the 1st of July 2014. We then further have to consider, since the acquisition date until the 31st of December this year, whether anything happened that has an impact on this journal entry, or this adjustment entry. If it is, and this is then the current financial period, it will be disclosed or included as separate adjusting entries in the consolidation worksheet. So for this question, we had to consider the inventory that was sold, because when an asset is sold in the current financial period, it means that that asset is de-recognized, and we want a transfer from the BCVR to retained earnings. Then any adjustments to and from other reserves originating from pre-acquisition equity, because that affects our retained earnings on acquisition. The remeasurement of the liability, which is basically a de-recognizing of a portion of the liability. Therefore, there's a transfer from BCVR to retained earnings. And then the call of the 25 cents on the share, because in the end we want our full investment in subsidiary to be eliminated, and after this entry there would still be a balance in that account relating to the call that was made subsequent to the acquisition date. So let's see where those adjustments are in the current year. So 90% of the inventory was sold. The after-tax BCVR adjustment that related to that 90% of inventory was to the value of 3,150. So we transfer it now from the BCVR to retained earnings. Now, if you listen to what I'm saying, you transfer it from BCVR to retained earnings. That's not what this journal entry looks like. But it's important to remember that these entries are only adjustments to the combined results of the group to get to what it should be from a group perspective. So these entries are only passed on group level and should be viewed in terms of this basic entry or basis entry. So our BCVR is debited in this account, in this adjustment entry. We want to transfer it from the BCVR, so we have a credit to the BCVR to reduce it, and a debit to the retained earnings to increase that adjustment on that line item. The remeasurement of the liability should then basically just be the other way around. So we transfer it from the BCVR or from retained earnings to the from the BCVR to retained earnings, but because it's a liability, it's just the other way around. So it's actually going to increase our BCVR, so therefore it's also a debit to BCVR, and it's going to decrease our retained earnings. So therefore it's a credit to the retained earnings line item in this entry. The transfer of the general reserve, it's from retained earnings, so therefore it's a credit to this account, so that it's from that it reduces this balance, to the general reserve, which is now debit, because in terms of this entry it has to increase this balance, so debit entry. And then lastly, the call that was made increases the share capital. So in next year this entry will be for 100,000, and it's going to increase the shares in subsidiary line item adjustment, so that in the next year when we pass this adjusted entry, it's going to eliminate the full investment in subsidiary.